Welcome to GRE. I'm your host, Keith Weinhold. Time versus money. What's more valuable? What are the trade-offs? And what's the ultimate solution to your time versus money problem? Then, I've discussed high inflation and interest rates on the show quite a bit this year, so let's get a terrific guest's take on this today on Get Rich Education. Mid-South homebuyers with over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your return on investment as their North Star. It's no wonder smart investors line up to get their completely renovated income properties like it's the newest iPhone. Headquartered in Memphis with their globally attractive cash flows, Mid-South has an A-plus rating with the Better Business Bureau and 4,000 houses renovated. There is zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate with an industry-leading 3.5-year average renter term. Every home they offer you will have brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and wait for it, a high-quality renter in an astounding price range, $100 to $150K. Get to know Mid-South. Enjoy cash flow from day one at midsouthhomebuyers.com. That's midsouthhomebuyers.com. If you're looking to grow your passive income from real estate, pay attention. My Property Stats is a deal analysis tool developed by an active investor to cut the time it takes to analyze any deal by over 90%. For any real estate class, you can calculate the exact price to pay to hit your cash flow and IRR goals. Build a world-class pro forma. Calculate the most you should pay for a renovation. Run multiple scenarios with a comparison tool and more. My Property Stats is the all-in-one toolkit for real estate investors. That means more deals, more cash flow, and more returns. Go to mypropertystats.com/GRE now and use the coupon code GRE to get 10% off your first year. That's just $90 a year for a tool that can save 10 hours per deal. No more spreadsheets, no more juggling multiple files. Use coupon code GRE to get 10% off at mypropertystats.com/GRE.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Henderson, Nevada to Hendersonville, Tennessee, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. You are back in that abundantly minded financial place, and you've got to be in a world where the scarcity mentality is abundant and the abundance mentality is scarce. In fact, is money a scarce resource? Do you believe that money is a scarce resource? A lot of this has to do with the programming that you received as a child and what types of learning that you've sought out since that time. Most children are taught to believe that money is a scarce resource. They become indoctrinated into that line of thinking, and then they never seek out any alternative source of light to that line of thinking. And so much of this revolves around time versus money. In fact, what's more valuable to you, time or money? If there's any doubt in your mind at all, consider this. Warren Buffett is 92 years old and he has a personal fortune of over $100 billion. Would you trade places with Warren Buffett? No. No, you would not trade places with him. Chances are you're a lot younger than 92, and this helps you see that time is more valuable than money. A tumor caused Steve Jobs' untimely death at age 56. All of his money couldn't save him. Now, when you're in your 20s and 30s, it's easy to believe that money is more important than time. I think it's actually pretty easy to believe that then. You've all heard the phrase, time is money, right? You hear that saying throughout your life. And a lot of times when people say that time is money, they seem to emphasize the last word. they say it like, hey, time is money. People, when they say it that way, they emphasize money's superiority in that statement. The last word, money, that's emphasized to demonstrate that time is so important that it could be converted to an even more vital resource, money. Well, they've got that backwards. But for, I think, most people in their 20s and 30s, they really believe that money is more valuable. And it's easier to believe that then because in your 20s and 30s, you don't believe that you have much money yet, and yet you have a lot of time left to live. And by the time that many wise people reach their 40s, not most people, but many wise people, I think this flip-flops. They understand that time is more important because by then you're going to have more money and less time left. Some people never have this epiphany until they reach their deathbed, and then they know that they'd rather have more time than money at that point. Society wants you to think that money is more important so that you'll keep selling your dollars for money at a job. Russell Gray, the real estate guys, he calls something the two-step. Yeah, the two-step. That's when you think that you'll just keep trading your time for money until you have enough money so that you can spend your time however you want. But by then, all you've done is that you've postponed your one and only life on this earth. Well, I've got some good news for you. The good news is that you can just largely forget all of that stuff. There is a solution here. Yeah, a solution to your interminable time versus money conundrum. And that solution is cash flow. Yeah, residual income solves your quandary. Cash flow solves the time versus money enigma. Income that appears with little or none of your own involvement, and it recurs, whether that's from rental real estate income or something else. So think of your time as an asset. It is an asset. Cash flow makes your time asset appreciate. And in the business world, so does outsourcing tasks and adding a system. Rather than selling your time for money in the hope that you can buy that time back later in your life, set up a system so that money recurs today, and next month, and next year, and next decade, and 5 decades from now. Cash flow erodes the faulty belief that money is a scarce resource. Another important thing for you to keep in mind is that not only does cash flow erode the faulty belief that money is more valuable than time and that money is a scarce resource, understand that your brain is nearly 2 million years old, the modern brain as we think of it today. Well, your brain is designed to make you survive. So no matter how much money you get, how much success, there is this part of your brain that will still keep looking for what's wrong somewhat. That will never totally go away. Perhaps the strongest human motivation is fear of loss. Yeah, fear of loss. Really, that is a strong predictor of your future behavior and of mine as well. Your fear of loss is high when you trade your time for dollars. Yeah, that's because you equate a loss of money with a loss in your time and your effort that you expended to earn that money in the first place. But instead, with each passing month and year, the greater and greater proportion of your income that becomes passive cash flow, and therefore the less proportion that is active income, your fear of loss just keeps getting chipped away. It keeps eroding away. Make your cash flow stream durable and increase the percentage of that income in your life. Your fear of loss is going to be diminished. Your belief that money is an abundant resource will be heightened, and you'll be fully immersed in the belief that time is more valuable than money. That is your solution, and that's how to get there. And of course, we discuss the strategies for getting there every week on this show with the most proven wealth generator for investors, real estate. Hey, and then you can become a time billionaire. Ultimately, that's what a lot of people really want. Last week here on the show, I mentioned recession prospects. Well, the latest quarter's GDP accelerated at a rate even faster than economists expected. American economic growth has turned positive. That is good news for your financial health and for that of your tenants. We've got a narrowing trade deficit. We've got increases in consumer spending. Like I said last week, is 70% of the economy. And we've even got increased government outlays. And that's in addition to the fairly strong job market. But not all is well. And you might remember that earlier this year, 2 previous guests on the show said that they believed we are in a recession. Well, the previous 2 quarters showed a slight economic contraction, even while the job market and consumer spending have stayed strong. And now I want to reiterate that I have never said any such thing myself. I have never stated that we are in a recession. And as close as I've come is saying that we're either in one or we're on the brink of one. And note that I'm not calling my 2 guests' opinions wrong either. I just haven't called it one. I want to clarify that for you. Yeah, we could soon be getting there, though. I'll discuss economic vibrancy with today's guest. He has been with us here 3 times before. And previously, before he was in real estate, today's guest was in the high-tech industry. In fact, for about a decade, 54% of the phone calls in North America were routed by a chip that he designed. And the more that I got to know him a few years ago, I learned that he has quite a family pedigree as well. He's a real estate investor and developer, and as we talk, understand that he often talks in terms of 5+ unit apartment buildings and commercial real estate terms, more so than residential 1 to 4 unit real estate terms. Here's today's feature guest. Hey, well, I'd like to welcome back a longtime friend of the show. He's a real estate and macroeconomics pro. He's an expert on raising capital, where he's authored an influential book. He's a frequent speaker at prestigious real estate events. He is the host of the Real Estate Espresso podcast. A Canadian, he also runs the Ottawa Real Estate Investors Organization, yet he's got time to be here, although he largely does invest in the U.S. Welcome back to GRE, Victor Menasce.
Great to be here, Keith.
Hey, it's so good to have you. It's been a few years. So much has happened. So much has changed. If you're listening in the audio only, Victor's last name is spelled Menasce. And Victor, so much has happened. I know oftentimes you discuss global instability. As we talk in today's conversation from bigger picture to smaller picture, what are your thoughts with regard to global instability?
Well, first and foremost, real estate is always hyperlocal. It really starts at the hyperlocal. It's so important to make sure that you are focused on that first and foremost. And at the same time, so much of what's happening in the world of real estate investing is in fact being dominated by the macroeconomic environment. The cost of capital has gone up so much with the increase in interest rates. And if you're locked in for 30 years and you're good to go, well, then this is completely of no interest to you whatsoever. But if you are looking to do new projects, if you have projects that you have been contemplating, or if you have projects that you financed initially with bridge debt, which a lot of people do, hoping to refinance into permanent financing, this is a major, major concern. So the macro environment is absolutely dominating the hyperlocal today.
And of course, this hike in interest rates is due to inflation. I know you've characterized today's phenomenon as what you call secular inflation, this long-term inflationary trend. And this really causes pain for some people. And interestingly, with you being a Canadian, you can relate to this in your local market, perhaps there at the Ottawa Real Estate Investors Association, since typical Canadian loans reset to market rates every 5 years. Therefore, could a borrower's mortgage payments, which is often the biggest payment in their life, double or triple overnight there in Canada?
It absolutely can. And there's a lot of even commercial loans, even in the U.S., that are written on a 5, 7, or 10-year term, and you can experience the same thing in the U.S. If you happen to get agency financing, Fannie or Freddie or something like that, where it's a fully amortized loan, then, that's some of the best financing out there. And you definitely want to get that and get it rate locked as early as possible for as long as possible. And yeah, it's a major issue, making sure that you have enough financial runway. And we saw it even in the wake of the great financial crisis post 2008, that there were a lot of borrowers, even in the U.S., who made every single loan payment on time. And then that note came up for renewal at the end of a 5 or 7 or 10-year term, and they were upside down. And the bank said, well, you can keep the loan, but you're going to have to write us a check for 50, 100, 150 grand just to keep the loan in good standing. And some people didn't have them. Those were called maturity defaults, where the loan matured and they simply didn't have the cash to bring to the table to fix an upside down situation.
Truly a concerning time. Here for a long time, we have just recommended the plain vanilla loan, the 30-year fixed rate mortgage. And those that have done that have certainly been the beneficiary. And oftentimes the world looks at American borrowers with envy. In a sense, we are the ones that get to decide if and when we want to reset our rate. So if mortgage rates climb up, we're already locked in. And if they go down, we can go ahead and alter the deal, if you will.
Absolutely. And yeah, that's a great thing. Now, of course, a lot of these longer loans come with yield maintenance, which means a prepayment penalty. In a lot of cases, you might have prepayment terms that might be on a 10-year calendar. So 10% prepayment penalty in year 1, 9% in year 2, 8% in year 3, and so on. So you want to be careful about prepaying a loan. But in a lot of cases, especially if it's commercial, some of these 30-year loans and 35-year loans, if you're working with HUD, those can be assumable loans, meaning you can sell them with the property. Now, of course, in the world of residential underwriting, you don't have that flexibility. It's absolutely due on sale. But with commercial loans, you often have the ability to have an assumable loan as well.
Sure. In the multifamily and commercial space, those prepayment penalties are certainly more common, even here in United States real estate investing. Can you speak more to the global instability and the ripple effect that that's having throughout the economy beyond just interest rate hikes?
I'm seeing signs in the marketplace that are looking very 2008-ish in terms of the way banks are behaving with each other. And even prior to the great financial crisis, the signs were there in 2007. If you look at the banks that were accessing the discount window at the Federal Reserve looking for liquidity. Now, back in those days, they were doing it often through the hands of a dealer, often Citibank or someone like that, so that if you were a weaker bank like a Washington Mutual or a Wachovia or someone like that, you weren't putting necessarily a big flashing red light bulb on your forehead saying, I'm in distress. So oftentimes, a larger, more established bank was taking the hit for that. But today, accessing a liquidity facility like that has a stigma associated with it. And so banks are very reluctant to do that. If you want to see those types of transactions happening, they're happening in a much more clandestine manner. So, for example, over the last couple of weeks, there have been a number of transactions happening through the Swiss National Bank, where the Swiss National Bank was conducting what are called currency swaps with the Federal Reserve. So these are typically Swiss subsidiaries of foreign banks that are looking to get US dollars, and they're doing it through the back door, through the Swiss National Bank, to essentially obscure who the real troubled party is so that you can kind of hide that, keep that out of the public eye. And there's a lot of that sort of activity going on, an increasing amount of activity. And it's something we need to pay attention to, because those signs of instability, the lack of liquidity in the market, and when we say lack of liquidity, what that really means is the quality of the collateral that is being pledged for this liquidity is often being put into question. And so it would make sense, for example, that, say, Italian sovereign debt would be priced differently, would come at a premium compared with, say, Germany, or that, you would pay more for Argentinian debt than you would pay for the UK, and so on. And you've got to pay attention to what's happening. There's really 3 escape valves that anyone in financial distress has. Number 1, they sell an asset. Number 2, if it's a sovereign situation, then it's captured in the exchange rate. We've seen that recently with the United Kingdom. And number 3, you see it often in rising bond yield, which means the value of that debt is falling. In order to increase the yield, That's the market telling you that they want to attach a risk premium to that piece of paper by giving that piece of paper a haircut, give it a value reduction in order to increase the yield. So those are the three typical escape valves that we see. And if you look, for example, at what's happened in the UK over the last several weeks, you see all three of those at play. Absolutely.
Lenders applying a risk premium, basically charging a higher cost of money reflected in an interest rate to compensate for lesser quality collateral. We're seeing that all over the place. The UK has a lot of problems. I was recently talking about how oftentimes for homeowners, their rates reset every 2 years or every 5 years. So it can happen even sooner there than it can in Canada for sure. So Victor, when this hits us on the street level or on the homeowner level or on the borrower for an income property level, do you see where potentially we could see banks doing things like freezing home equity lines of credit? Because you talk about the problems in the liquidity market. How can that trickle down?
Absolutely. We could see lines of credit get pulled in. For example, you might have let's say a $200,000 line of credit against a property, and you get a letter in the mail saying, congratulations, your line of credit's now been reduced to 50,000 or some smaller number. And then really you have no recourse at that point because the mortgage is still in place. The mortgage is typically recorded at more than the value of the property. So even if the loan amount was for 200,000, they would have probably recorded a mortgage for in excess of the value of the property to prevent you from putting a second lien on the property. And you have very little recourse at that point. So it's something we definitely need to pay attention to. Maintaining dry powder, maintaining liquidity, maintaining cash is not something you want to do a ton of in an inflationary environment because you're definitely losing value. And at the same time, you got to have some cash for those types of surprises when they occur. And I suspect that we're going to see some of that over the next 12 to 18 months.
You've got to have some cash in all times. As wonderful as real estate is, it's not a great idea to hold your reserves in real estate, really in any market. And now, especially since we're talking about a liquidity crisis. But Victor, a few minutes ago, you opened things up globally. You were talking about Europe here within this context of interest rates and inflation. Of course, the Fed has been having their rate hike palooza here for months and months now, and really no one sees an end in sight there. So really, my thoughts macroeconomically, does it make more sense for the free market to set interest rates rather than Jerome Powell and the Fed assigning interest rates and changing them at will and having central bank control over those interest rates? Because if we think about an economy and in a free market economy, consumer goods, everything from a 5-pound bag of Domino sugar on the grocery store shelf, that price is effectively set largely by the free market all the way to a brand new 2023 Nissan Rogue SUV. So we can think of interest rates, therefore, as the cost of money, not the cost of sugar or not the cost of an SUV. So therefore, can the free market or should the free market be dictating these interest rates that the Fed sets? How would that work?
Well, I think that, in fact, that the market is setting those rates, not the Fed. So what happens is the Fed sets a rate for their very short-term debt. But when you actually look at the way the banks assign an interest rate to a new loan, it's based on the market yield on the 10-year Treasury. So even though the Federal Reserve only makes an announcement once every 6 weeks, those mortgage rates are fluctuating daily, hourly. They're fluctuating continuously because the marketplace is saying, here's what we want to pay for that 10-year Treasury. A few weeks ago, the number was in the threes, 3.6, 3.7, 3 now we're over 4. But the Fed hasn't made any announcements in that time frame. It's been the marketplace that's actually been dictating what that yield is by either assigning a risk premium or saying those treasuries are worth more or less. So those are market forces at play.
I'm really glad that you brought this up because I've been informing my audience that the Fed funds rate does not move in direct lockstep with the 30-year fixed rate mortgage. It's more tied to the yield on the 10-year T-note. And historically, the spread on the 30-year mortgage is about 1.75%
exactly
above. Can you talk to us about that spread and why currently that spread is substantially higher, probably reflecting a risk premium from the banks?
There is a spread, and then on top of that, you've also got a mortgage insurance premium. Because when you are working with an agency and you're getting non-recourse debt, now again, world of residential is different, But in the world of commercial, if you're getting non-recourse debt, essentially what's happening is that agency is becoming the guarantor on the loan. Whether it's Fannie or Freddie or HUD or whoever it might be is acting as the guarantor. So in that situation, they will often charge a mortgage insurance premium on top of that spread. So it's typically a quarter point, maybe a half a point. And we see the same thing in Canada. Canada has an analogous facility called the Canada Mortgage Housing Corporation, CMHC, which kind of fulfills a very similar role to HUD in the United States. And it's a very similar type of process.
So I think what you're telling us really is mortgage interest rates are somewhat of a hybrid between policy that the central bank sets and the free market.
That's exactly right. And it makes sense because if you think about it, I mean, typically these lenders want to be in first lien position. They don't want anyone in second lien position. They want absolute security so that they can control their risk. If you want the very best rates in the marketplace, then the only way you're going to get that is if the lender is dealing with a known quantity within a very narrow set of parameters that they get to set.
You listen to Get Rich Education. Our guest is Victor Menasce. More when we come back. I'm your host, Keith Weinhold. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the eQRP company can fix this. Those IRAs can be converted into eQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. In this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the eQRP works. It's the solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest eQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4 plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. Knowing the difference between a turnkey provider and a vertically integrated rental property company can cost you hundreds of thousands of dollars over the life of your investment. Some companies sell you a property they don't own, renovate it with contractors they don't control, refer you to a property management company they don't manage, all in multiple markets because they can't source enough inventory. That's why truly passive investors work with our friends at JWB Real Estate Capital, perhaps the country's only vertically integrated rental property investment company. They operate in one market, Jacksonville, Florida, and their whole job is to make investing in rental properties easy for you. In fact, because of their vertically integrated approach, their clients have gained 79% more home price appreciation than the overall Jacksonville market since 2013. Find out more about why it pays to invest with JWB. Call them at 904-677-6777 or go to jwbrealestate.com/GRE.
This is Rich Dad Advisor Ken McElroy. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Victor Menasce about largely macroeconomic forces and how that trickles down to you as both a real estate investor and a homeowner. And of course, Victor, we're in this interesting time where we have both heightened interest rates and heightened inflation. Many can argue that the real diminished purchasing power of the dollar might be, for example, double what mortgage interest rates are today. So therefore, we're really borrowing for less than the cost of inflation is. So can you tell us how one can best navigate that? Because prices and interest rates are up, but so is inflation.
It's a real dichotomy. It's a contradiction in terms, if you will, because you have these things that seem to be opposed to each other, and yet it's hard to make sense out of it. So let's start with what happens in the world of inflation. You're essentially devaluing the currency. So what gets wiped out? Your purchasing power for those on fixed income, your savings get wiped out, and so does debt get wiped out. So all three of those are being devalued equally. Now, if you know that that's the name of the game, then what you really want to do is make sure you come out on the winning side of that equation. How do you do that? You want to maximize your debt, albeit responsibly. You get over leveraged and bad things happen. But if you maximize your debt to a responsible threshold, then that debt gets devalued. You're paying that debt down in the future with dollars that are worth less. So, very simple example. If we look at the very first home that my parents purchased in 1967, they bought it for $42,000. It hasn't grown. It hasn't changed. It still has 4 bedrooms. It's not any larger. There might be a little bit of market appreciation. Now, imagine if they bought that at 100% loan to value. They made 0 down payment. They paid 100% loan to value. And they made no principal payments from then until today. They just paid the interest only. Let's imagine if that happened. Well, today, that same house would sell for about $850,000. Now, has it really gone up in value? No, it's gone up in price. Now, they would have gone from 100% loan to value to less than 5% loan to value over that time frame. And that's the magic of inflation, is devaluing that debt. So the benefit goes to the equity holder in the equation. And that's what you always want to remember. So in the world of negative real interest rates, if you are borrowing money and paying it forward with future dollars that are worth less, then essentially the government's giving you the license to print money. And so you always want to remember that. At the same time, you have a problem, which is you do the math, you sit down with your Excel spreadsheet and you'll look at what's happening with real interest rates, and you look at your pro forma and you say, oh my gosh, I'm debt coverage limited. I'm potentially even negative cash flow. If I want a high ratio loan, how do I make this work? It looks like on paper I'm upside down. And so in order to navigate that, 2 things need to happen. Number one, you got to be a pretty good predictor of what the future is going to be, which none of us can be. And number 2, you want to figure out how to model that inflation going forward. Betting against inflation would be a bad bet. We have 100 years of inflation doing its magic. Even in a deflationary environment, there's still inflation. You don't experience deflation across the entire economy. You experience it in pockets. So the key is to figure out how to model that. In a world of negative real interest rates, even if you believe inflation today is running at approximately 8.5%, if you're borrowing at 6%, you still have negative real interest rates. The government's giving you 2.5% for free each and every year. So you want to take advantage of that.
Well, I love that example with your parents' 4-bedroom home. It was a 4-bedroom home back when they bought it in 1967. Ostensibly, it still has the same utility value. It still sleeps people in 4 bedrooms today. So therefore, only the price has changed. The value really hasn't. And yes, borrowing at less than the rate of inflation is obviously such a sweet deal for the borrower, and a lot of people overlook that. So what one has the opportunity to do is pay back the bank with dollars that debase on them faster than their interest rate can accrue on you. And really, that's just one of the 3 crowns that I've characterized this, Victor, as the inflation triple crown, that real estate investors, when they buy income property with the loan, benefit from the asset inflation, the debt debasement that you've touched on so well, and then thirdly, this cash flow enhancement benefit. When you raise the rent $1, your cash flow might go up $2 for every $1 that you raise the rent when you're leveraged like you are, since your principal and interest stay fixed. So really 3 simultaneous benefits to real estate investors is how I've characterized it in this inflation triple crown that one wins.
Well, and that's absolutely right. But the thing to remember is that works, let's say, on average, and there's no such thing as average. So you can still find yourself in a situation where you can model, let's say, average inflation at, say, 3%. Pick a number. It doesn't matter what it is. You say, all right, let's say inflation's at 3%. I'm going to assume 3% rent growth. I'm going to assume 3% growth in expenses and so on. And when you do that on paper in your Excel spreadsheet, you will see that your profit increases year over year. But at the same time, if anyone's been paying attention, you'll know that salary increases have been far less than the rate of inflation over the past 24 months.
About 5% per year. Yeah.
Yeah, exactly. So you're starting to hit the wall in terms of affordability for rent growth. So your assumption of rent growth may or may not be valid. If it's not valid, then your entire economic thesis falls apart. So you got to figure out the affordability for your specific customer segment. If you are in C-class apartments and you're at that bottom of the economic ladder where ability to grow income and ability to grow rent is probably less than it might be in a B-plus asset, you've got to look at your underwriting much more conservatively.
Well, that's a great point. And as we've looked across the landscape in this era of, if you will, global instability and secular inflation, a lot of times investors want to know, okay, now what else can I do? What other actionable steps can I take in this scenario? And I really want to preface this with, there's always uncertainty. There's uncertainty in every market. Back in 2020, people were a bit spooked because of the global health crisis. In 2021, it was the low housing supply and a housing frenzy. And today it's recession fears. And a lot of those fearful people in 2023, they'll have something else to be fearful about. But oftentimes, fear can help steer our actions. So what are some of the best ways to do that in this environment for real estate investors, Victor?
Well, number one, if you're on a variable interest rate loan, get rate locked as quickly as you can. I would run to the bank, not walk, in order to make that happen. That's number one. I've had so many investors approach me, even recently in the last couple of weeks, saying, well, do you think I should rate lock? I mean, the variable rate's cheaper. Well, my question back to them is, how far do interest rates need to rise before you're upside down, before you're cash flow negative? And the answer often came back, well, they probably only need to go up another 3/4 of a point. Well, I'm saying, well, why would you take that risk? Why would you take that risk? Rate lock now, something that you can live with, as opposed to something that's going to be very painful for a long period of time. So that would be number one. Number two, and this is something that a lot of investors need to pay close attention to, because when you are doing a value add project, meaning you are not purchasing a stabilized asset, you're going to do some improvement. Maybe it's a remodel, a renovation, maybe a repositioning of an apartment complex, whatever it might be, you're almost always going to do that with bridge financing. And you would have maybe undertaken that project in 2020 or 2021, expecting your permanent financing to start in the 3s or maybe the 4s. Well, now it's in the 6s.
Yeah.
You were hoping to do a cash out refinance and get some money back, take some equity off the table in that refinance. And now you're facing the prospect of having to write a very sizable check just to get into permanent financing. There's a lot of folks out there like that. Probably 80 to 90% of multifamily repositionings were done with bridge debt. And a lot of them are going to be in trouble when they try to get into permanent financing. So that's an opportunity, because those folks have no path to get into permanent financing. They might extend their bridge loan until they run out of extensions, but at some point, they're going to be facing a distress sale, one way or the other.
Oh, well, these are some great actionable takeaways about what's going on in today's real estate market and how we can respond. This has been a really helpful chat for a lot of people with a lot of actionable stuff. Well, Victor, if our audience wants to connect with you, what is the best way for them to do that today in all your brilliant resources?
Well, I'm the host, as you mentioned, of the Real Estate Espresso podcast. It's a daily show 7 days a week. So it's espresso like the Italian coffee. And love to have that daily conversation with you. The weekday shows are just 5 minutes with just me, and the weekend edition are interviews with notable people from the world of real estate investing. So it's a bite-sized it's literally your morning shot of what's new in the world of real estate investing every morning.
Victor, it's been valuable as always. Thanks so much for coming back onto the show.
Great to be here. Thank you.
Oh yeah, great insight from Victor as usual. To be clear, at times he discussed commercial loans that have prepayment penalties, but those prepayment penalties do not exist in 1 to 4 unit residential loans in the United States, which are what we usually talk about here. Hey, a lot of great shows are coming up for you here in the near future, including revisiting the tiny home movement and the latest there. It takes a team to put this show together each week. Big thanks to COO Andrea Newbern, Content Manager Matthew Blunt, Investment Coach Naresh Vissa, Sound Engineer Vidran Jampo, Websites Marvin Diaz Jr., and Advertising Jake Madoff. If you've ever wanted to leave feedback about the Get Rich Education podcast, but you haven't quite gotten around to it, I'd like to ask something of you, 2 or 3 minutes of your time. I'd be grateful if you left a podcast rating and review on either Apple Podcasts or Spotify. And if you don't know how to leave a review, just Google, for example, how to leave an Apple Podcasts review. The rating part is the 5-star thing, and the review part is a few sentences about how others might find the show as valuable as you have. So if you've ever wanted to leave feedback, and I will read your feedback myself, I would really appreciate your podcast rating and review on either Apple Podcasts or Spotify, wherever you listen. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.